David is going to kick off the presentation, but I just wanted to introduce myself. My name is Iris Chung, and I'm a senior manager with the SALT Group. David, it's all yours.
I'm David Casper, and I'm state and local tax manager out of our Fargo office. I will be taking you through a couple of portions of this show. And so the world has changed, and this is just sort of become our new reality. I'm watching the news and different publications, and what I'm seeing is, and this was just through like mid-April, these are the numbers that the state's revenues or some of these counties are showing as shortfalls just in sales tax revenues. Florida, Georgia, major shortfalls in revenue. They can't keep this up indefinitely. And like the number for New York State and Los Angeles County, that is their revenue shortfall due to sales tax. They're supposed to work on a balanced budget. The states are going to start doing things, whatever they can do, to raise those revenues. And they have a couple of different options. And option one is they can raise taxes, whether it be property taxes or sales taxes. That, in theory, increases your revenues. The drawbacks to this are takes usually some legislation to get those things approved. Maybe there's a vote that's required. The public perception on raising property taxes or sales taxes at a time like this probably isn't too great. Our option two is they're going to increase sales and use tax audits. It'll increase their revenues. A lot of times they will be auditing companies who are out of state instead of people who might vote in their state. They already have the staff in place to do this. Nowadays, a lot of audits are handled just through email. My bet in the near future will be that we will see an increase in sales and use tax audits, a market increase. And some of the ways that they're doing this, one state has been sending out notices based off the disposal list in your federal income tax return. If we can get this slide backed up somehow. So they're looking at the asset disposal section in your federal income tax return, and they're saying, hey, we noticed you've disposed of all these assets. Please prove to us that you charged or paid sales tax on them. Where this is effective is in states that do not have occasional sales rules. Like a South Dakota might do this, Oklahoma does this. They're just fishing for revenues. It's an easy way to do it. They can do it in the software, and they send out a notice. And they generate, a lot of times people miss that, and instant revenues. Another one that we've been seeing, especially for like a single location business, if you picture a restaurant. A restaurant in the middle of a state is probably only going to have revenues generated from that location in the middle of the state. In theory, their gross revenue on their income tax return and their sales tax return should match. There are some states out there who are cross-referencing these numbers, and they're sending out notices to people saying, oh, we noticed this discrepancy between the two. You owe us X amount of money, or please prove these discrepancies and why you don't owe us the money. That's another just sort of automated way that they can increase their revenues. One that states have been doing for a fair while now is they're sending notices to companies with stock in the Amazon warehouses. They were able to subpoena the records, who's got stock in these warehouses. They cross-reference that with who's in the state and who's filing an income tax return or withholding return. They cross-reference those federal IDs and start sending out notices. Dear sir, we noticed you had inventory in our state and you are not filing any taxes in our state. Due to physical presence, you may owe us some income tax and or some sales tax. And another one that I've been seeing quite a bit of lately is they're comparing who's filing income tax returns and payroll filings in the state to the sales tax permits. In theory, if you've got payroll in the state, you should at least have a sales tax permit just for remitting tax on untaxed office supplies, if not actual sales. States are getting very aggressive. We've been seeing these newer things come out. We just can only anticipate that there will be more in the future, and more of us will get to participate in a sales tax audit. Okay, the auditor's coming. What can we do? We can do a lot of things. Typically, I like to right away get after the big ticket items. They will always ask for your fixed assets. Your fixed assets are not only noted on your income tax return under the additions in the 3 or 4 year period they're going to audit. They have a good hint there. They'll also be probably listed as for depreciation. They'll want to see for sure everything that's in the fixed asset list that you bought in the last 3, maybe 4 years, and you should have receipts for it. If you don't have them in order now, or you think they're partially in order, get it done now. I usually recommend that the minute people get that audit notice, start working on this right away. These are big ticket items. There's going to be a lot of stress. You may not have time to go for all the invoices. Let's get it done now. Same with usually looking at, let's run a report of every exempt sale you've made. Run that out by, these are my customers I sell exempt to. Here's the top of the stack. Do we have valid and complete exemption certs on file for them today? If not, let's get working on it immediately so that when the auditor shows up, that part's ready to go. We can just hand those off and deal with the rest of the request. One thing that we see a lot of, unfortunately, is prior periods being unlocked or left unlocked in the business system, such as we ran a ticket last month, end of the month, we ran the sales tax return, we filed and paid the sales tax. Customer comes back, oh, I wanted to return this, or you charged me tax and you shouldn't have. A lot of people take the easy way out. If they can go in and reopen the old ticket in that prior period, make the adjustments that flow through and make the customer's books look good. They get back the money they needed and we're done. But one of the things the auditors will do is they'll rerun the sales tax reports, or they'll ask you to run sales tax reports for them. And when they go back and do that, that month won't match what you filed because that period was not locked. And at that point, you're presumed guilty until you can prove yourself innocent, and it's tough. Because when it's happening in a company, it happens a lot, and you may never figure it out. Another good way to prepare is to have somebody come in and do a mock audit. Have them sit down and pretend to be the auditor and see what you find. We found that even just asking auditor type questions for an hour and a half, 2 hours, usually lets people know where they're sitting at. They get a good idea of, oh, I have some issues I need to get working on, or I'm in a good spot. That way, when they do get the notice, there's some assurance that it's not going to be as bad as they thought.
So David's gone through what it takes to prepare for an audit, and I'm going to step back in time. So it says sales tax today, and I actually wanted to go beyond past 1992, back into history. Sales tax has been laws framed out by the U.S. Supreme Court, and with an interest in the Supreme Court wanting Congress to participate in establishing some overarching rules that you'll see as I explain through the cases that had not occurred and prompted the Supreme Court to come down with some decisions. So business in the past with what we do in the internet was done through catalogs back in the past, and it had been done it through catalogs, and the question was, how would states be able to capture that sales revenue where catalog companies are selling throughout the U.S. And the first significant Supreme Court decision was Bellis Hess in 1967. In Bellis Hess, this was a mail order company selling women's clothing and household goods, and that was based in Missouri. Illinois was the state that challenged this case, that basically they asserted NEXUS because the mail order company was mailing catalogs through the U.S. mail, common carrier, no other presence in Illinois, but it would ship its product to its customers in the state, and that was through third-party U.S. mail and common carrier. The catalogs were mailed out twice a year. There were advertising flyers as well. There were no telephone listings, no ads in newspapers or billboards, or through radio, TV in Illinois. And in that case, the U.S. Supreme Court said that there was not an ability for the state to tax Bellis Hess because it didn't have physical presence. So that was the first Supreme Court case on sales tax, and it was established as the law. So quarter of a century later comes Quill. This is before the decision that was overturned in 1992 by the Wayfair decision. Quill was a Delaware company that sold office equipment supplies, also through catalog, flyers. They did some advertising. They had periodicals that they sent, as well as telephone calls. And through Quill, this was a North Dakota case in which there were no other physical presence, no warehouses in North Dakota. And North Dakota's Supreme Court said, well, we don't want to follow Bellis Hess. We want to capture some of that revenue because there were 3,000 customers in North Dakota. And the Supreme Court, this case went up to the Supreme Court. They had to choose between overruling their former jurisprudence in Bellis Hess or reversing the state Supreme Court. And they chose to reverse the Supreme Court's decision. The court does note that there was a significant increase in mail order business. Is this sounding familiar? It's similar with internet business. It grew. It was a staggering 184 billion from 1967 to 89. There were great advances in technology. The court even acknowledged that the burden of sales tax compliance is probably eased with computer technology that wasn't present in the 60s. But nevertheless, the court still said that they didn't want to overturn their own decision, that there was still a due process connection. There was fair warning that there was activity from the Quill company in North Dakota, and that they felt that there was due process established, but they bifurcated and said that the Commerce Clause needed substantial presence, nexus, and that presence was established through physical presence. So they bifurcated and said that there wasn't sufficient, Quill did not have sufficient substantial nexus, and North Dakota was not was not able to tax Quill. So they were able to preserve their precedents and move forward and say that that still the law of the land is that you need physical presence. So we fast forward another quarter of a century to 1992 with Wayfair. This decision is almost 2 years old, so we still consider this to be fairly new law because the implementation is rather complicated, which you'll learn through this webinar. And in this case, it was Wayfair, also a retailer, Home Goods and Furniture, and Overstock, which is another online retailer. And in this case, this was South Dakota that was defending their law, where they had established a rule that said that you need at least $100,000 of goods or services or 200 separate transactions in the state to create nexus. And the court basically overturned their Quill decision and determined that that type of economic nexus rule would be deemed to be substantial nexus. So they overturned and said you do not need physical presence, and that's where we stand today. So what does that mean if you're not physically present in the state? Then the question then becomes, are you a remote seller? And remote sellers is anyone else that establishes nexus through a click-through, which is through the internet, where you would be clicking through, let's say an Amazon website into a smaller company's website, smalltownreseller.com, and that small retailer would also have nexus as a remote seller. New York, in fact, began enforcing these rules back in 2008 as an example of a state that tried to circumvent the Quill decision, the rule of physical presence back in the 2 years ago. Another way is through cookie, a web cookie. And what is that? For those, as a refresher, a web cookie is one that identifies users and prepares customized web pages. So a customer, Massachusetts was the first to try to assert nexus based on a cookie. A customer sitting in Massachusetts clicks on a website, a cookie comes out and basically collects information, personal information, interest, name of that customer. That cookie sits on the customer's browser in Massachusetts. Then the next time that you go to that website, that cookie goes sent to the server, which is outside of Massachusetts in most cases, and then collects that information and presents to the customer a customized website in Massachusetts. And Massachusetts basically said that they claimed that they established a law that said that Nexus was created with a cookie. It's been since overturned, repealed, replaced with $100,000 taxable Nexus threshold. But that was Massachusetts' attempt to circumvent the physical presence test. Affiliate nexus. This is an amorphous term, and because it's defined by states in different ways. One way is through if you have a business has sellers, representatives in a state that is independent but sells on behalf of the company. California says if you have an entity related in any way to your out-of-state business, that creates affiliate nexus. States such as North Carolina and Georgia have imposed dollar thresholds. If the business derives $10,000 or $50,000 in sales through affiliates in the state, that would deem the company to have nexus. An economic nexus is the thresholds that were established by the South Dakota in Wayfair, which is the 100,000 in taxable sales or 200 transactions test. So nexus, as a summary, physical presence That can be through sending agents in, a third party, as I mentioned, that can be an affiliate nexus as well, where a third party does repairs based on warranty. Selling taxable items at a trade show, that can be a one-off situation that happens a couple of times a year. And the challenge there is, when do you register? How often do you register? Do you file sales tax returns for year number one, but let's say you don't return to that trade show for a couple of years, then you might have to reapply. And some states have temporary permits. Out-of-state sellers that pay commissions to a state resident. Again, this fits under the affiliate. The affiliate creating nexus for that out-of-state company. Delivery of goods to customers using your company-owned or leased trucks. That does create a physical presence. And in that case, that $100,000 threshold or the 200 transactions, that doesn't apply, because that actually applies only to economic nexus. So physical presence still matters. It's just that physical presence and the potential of economic presence will create nexus for sales tax purposes. So nexus triggers, these are pretty hard, fast. As David had mentioned, payroll. If you do have payroll in the state, businesses will automatically get a notice as to why they haven't filed for sales tax as well. That is a very common trigger. Warehouses. Now that businesses are expanding, you might have an East Coast warehouse that would be added to your West Coast warehouse. So that automatically creates a sales tax filing requirement. Now, filing requirements don't necessarily translate to taxability, but it does create a filing requirement in the instance that most of your sales would be made for resale. Property. Having an office location, having certain assets that might be sitting at a customer's site. Inventory is pretty self-explanatory. And then revenue over 100,000, that's the economic nexus trigger. So a couple examples. Do I have nexus? So we've got an Arizona machinery dealership that sells a product, and it's delivered by common carrier, no physical presence, into Washington. Washington's economic nexus threshold for sales tax is 100,000. The contract price of this sale is 500,000. So do you have nexus? Yes. You've exceeded the economic nexus threshold. So you must register and file. So is this a sale that's just made in 1 year? What if it was just for one job? You don't enter again. For a retailer, you might want to consider the fact that you don't know where your customers might be coming from. You know, one sale, if you're large dollar ticket items, generally one item will exceed the threshold. You know, would you want to continue filing 0 returns until there's another sale triggered? This might be a different consideration for a contractor, someone that sells large products for particular projects, not a retailer. In that case, you might consider registering, filing in year number 1, but not filing in year number 2. Why is this a concern? The thought might be, well, if I stop registering and filing in year number 1, whatever sales I have in year number 2, the state won't know about. Perhaps I don't have any sales, but there is a concept that states know that businesses just don't turn on and off. And there's a trailing nexus concept, which means if you do sell 1 or 2 items in the following year and you don't register, those items would also be subject to tax. Here is another example. We've got an Arizona retailer that sells merchandise shipped by common carrier to a to California customers. The contract price is $100,000. The threshold is $500,000. So here, no physical presence because the items are mailed by common carrier. Do you have NEXUS? If there's no other physical presence and the items sold were 100,000 below the threshold, there is no requirement to file in California. However, what happens when you do have a retailer that actually engages a third party, an affiliate, that assembles that furniture in California for your customer? California has a rule that if there is an entity in the state that does work related to that out-of-state entity, it's an affiliate and creates NEXUS. So you might have NEXUS that's created in that way. So now I'll turn it over to David for the next section.
Okay. One thing I would like to clear up, I do once or twice a month I hear, but I'm not a remote seller. I don't have a website. You do not need a website to be a remote seller. It's any way, shape, or form that you are making sales from a location in one state and they are ending up being sold to someone in another state. That's all it takes to be a remote seller. When things first started out, Sears and Roebuck had a catalog. You could even order a house through that catalog. They were a remote seller pretty much everywhere in the country. Then then we had phone salesmen calling. People in California calling Minnesota to sell shop supplies. Phone sales, oh, that is a remote seller. At one point, we even used to get spam advertising on our fax machines. You would fill out the form and fax it back. Remote seller. One piece people sometimes miss is software, downloaded software. That's still a remote sale. Somebody in one state selling to another state, or even software as a service. It's still somebody in one state selling access to software to somebody in another state. So by whatever means you are taking revenue from that other state, you are a remote seller. And since it's close to noon, let's look at our friends here in Lexington, Texas. It's a barbecue joint. It's open Saturday mornings only, and they sell out in a couple of hours. And now this to me looks pretty low tech. You can still see the smoke coming out of the cookers. There is no way that Snow's Barbecue is a remote seller. Or are they? Folks have a website, and from here we can order online, and they'll take some of Saturday's product for us and flash freeze it and ship it to us overnight. I can buy t-shirts, hats, special sauces, special barbecue mixes, all sorts of things from their website. So even though they may not look like a remote seller, well, they are. It's actually pretty hard these days for a business to survive and not be in some form of remote sales. So are my barbecue pit masters remote sellers? I do believe they are. I mean, online, I can call down there and order on the phone. I can email. I can probably even do it through Facebook. There's just all sorts of things that this low-tech place is very much a remote seller. Okay, so maybe I'm a remote seller, but do I really need to register in every state? And what are the rules in these states? As things have been settling out, these states have said, these are our economic nexus rules. There's a majority of them that fall into what I call the only category. They only care about your dollars going into the state. And most commonly, those dollars are total dollars to the state. They don't care about wholesale sales, exempt sales, or anything else. It's just gross sales. There's a few that are in the or category. Most commonly, they're looking for $100,000 or 200 transactions. If you're someone who's selling $8 or $9 kits, if you sell 200 of those into a state, technically you're over the threshold. Sales tax exposure on that, probably not much. But if you are either over 200 sales or 100 grand, there's 1 or 2 states that have an and provision. They say you have to have so many dollars in sales and a certain quantity of transactions. And this really kind of protects the folks making big ticket one-time sales, so that they don't have to register. The machinery dealer who sells 3 bulldozers in there, yeah, he's maybe sold well over $1.5 million, but he hasn't crossed the 200 and he doesn't have to worry about it. There are, I believe, 1 or 2 states out there who offer this choice of you can either collect our tax once you've gotten over a threshold, or you have to go through these, you can do these reporting requirements. My version on these choice ones is just register. These states that offer this made it so difficult to comply that you were better off registering. At least if you did something wrong when you're registered, you only owe on those invoices where you screwed up. On the reporting side of it, they were talking $10 fines for every person you forgot to mail a notice to, and it just went on and on and on, and would cost you far more than any tax. If you hear about people doing the remote reporting, I would seriously consider giving that a miss. So we've got only a dollar amount or a transaction amount, or in a few, both styles. These are, it's kind of a breakdown of how they go. You'll see that most of these came into play late 2018, if not very early 2019. Most of them are 100,000. There are a few states out there that are over that. Like New York, here's one of our and states, 500 and 100 transactions. All right, that's kind of interesting. We do have a few states with their little twist. Taxable gross revenue in these few states, North Dakota, New Mexico, Kansas, Arkansas. I really don't like to look at taxable gross revenue too much. I prefer to consider total revenue, unless we have someone who is really almost exclusively a reseller or sells something exempt. Most of this chart is out on eidebailey.com. And if you just search the keyword Wayfair, it should come up, and we update it about once a month. So don't worry about this so much. Just kind of remember, if I'm over 100,000 in a state, I really need to take a second look at this. Now, when does NEXUS start? Well, first I want to read a piece off the Texas Comptroller's website. A remote seller whose total Texas revenue from sales into Texas in the preceding 12 calendar months, so that's a rolling 12, are less than 500,000 are not required to get a permit. The dollar amount is based on the gross revenue from sales of tangible personal property and sales of services into Texas. This amount includes separately stated handling, freight, installation, or other fees you collect. It also includes sales for resale and sales to exempt entities. Texas is very clearly saying our line is 500 grand in a rolling 12, and it's total sales. So we look at this example. We've got our 500,000 threshold listed. Q1 they did 350, Q2 they did 100. Somewhere in Q3 they crossed that line. They got over the 500,000 in gross sales. So when do we have NEXUS? Typically if it's a sale, like one sale that pushes you over the line, that sale doesn't meet the reporting requirements yet. But once you cross that line, this is when you need to go to the state's website and start looking at the registration. Most states will give you 30 or 60 days from when you crossed the threshold to register and get rolling. And let's see what our next slide has for us. We've got another example. Again, it's Texas, it's 500, there's a line. This one they're looking at taxable sales. Well, yeah, my taxable sales are only $350, but Texas pretty clearly says we're looking at gross revenue. So just like in the last example, we would have actually crossed somewhere in Q3, had 30 or 60 days to get registered. And we discussed this a little bit last time. If you see an option for reporting, seriously consider giving that a miss. If you are still seriously considering doing the reporting, give it a read and you will find out it's more difficult than actually registering to collect the tax. One I've been dealing with quite a bit lately is, will Amazon/Etsy/eBay/Walmart Marketplace or Target Marketplace charge the tax for me? This is based on what they call a marketplace facilitator. And if we look at Amazon is a marketplace where they're facilitating the sales of your goods. It's not just Amazon selling stuff. They are facilitating the sales of your goods, just like it's your goods being sold on eBay. The states kind of got together and said, well, instead of making all these people who sell on eBay and Amazon try to collect tax if they're over a certain threshold, they required these marketplace facilitators. All but 6 of the states, I believe, with the sales tax said, dear marketplace facilitator, if your sales are over so much into our state, typically 100,000, which any of these folks would be right off the gate, if you're over 100 grand, you need to charge, collect, and remit sales tax on all of your transactions on behalf of your sellers. And this kind of makes sense in a state for, if you've got people who are just real businesses selling on eBay, and they're doing a lot of volume. Where it gets a little bit off track is in a lot of states, you can have a garage sale. It's considered an occasional sale. You're selling off your stuff. It's not taxable. Same here in North Dakota. If I'm just selling off some extra stuff out of my house on eBay, before marketplace facilitator legislation, it would have been an untaxed occasional sale. Now it's being taxed on behalf of the sellers by the marketplaces, and they're remitting the monies to the states. This also kind of draws in those Eventbrites and companies that sell tickets. They're also drawn into this. Even though you sold something on eBay and you didn't intend to charge tax, eBay probably collected tax from your buyer in one of those states, remitted it, and you knew nothing about it. I believe there's a couple of states out there that are not collecting local taxes as well under the marketplace facilitator. But this is something to be aware of if you're selling in one of these marketplaces. I know that Amazon has it listed on their website where they're collecting these taxes. I would assume that the rest of them do as well. So as you can see here, there's a lot of, these states are all telling the big marketplaces, you need to collect on your seller's behalf. That's great. We have 45 states out there and 1 district that have a sales tax, but we don't have 45 of them listed here. So we've got these other states out there that haven't introduced marketplace facilitator laws yet. They're coming. It's just a legislative timing issue. They don't have them at the moment. but I would bet that by sometime next year, marketplaces will be required to collect sales taxes pretty much everywhere. But until this time, those sales going through Amazon that are going to these states without marketplace facilitator laws, if you're over the threshold in that state, you need to be registered and collecting the taxes and remitting them yourself. Also, one thing to keep in mind, yes, there are some people who sell strictly on Target, Walmart, Amazon, eBay. But there's a lot of them who also have their own website that they sell directly from. Your sales on Amazon can push you over the threshold in a state when combined with your website sales. You have to think of them as a whole, not as individual players. Back to some hunting. This is some states hunting sellers. The top one, California's been doing that for a while, going after people with inventory in the warehouses. Texas has been cross-referencing returns. Texas pulled a new one. They've required all sellers of ATVs, manufacturers of ATVs, like a Polaris, to report to Texas every serial number machine registered for new warranty at a Texas address. And then they are cross-referencing that ATV's serial number with the registration software at the state to see if there's untaxed ATVs out there. That was a pretty good one. I know North Dakota is doing some cross-referencing on withholding and sales tax. And New York is doing the same as California, chasing people with inventory in Amazon warehouses. Because even though Amazon moved it to that state, not you, it creates physical presence for you. And now we've got our last 9 minutes or so for Iris to take us through to the end.
Thanks, David. So sales tax is the predominant revenue that states receive to fund operations within the state to support, to balance their budgets. There are a couple states that also have gross receipts type taxes, transaction taxes to be aware of that also have economic nexus thresholds. The Washington B&O is a tax that applies even if you've never physically entered the state. It's got the same threshold as a sales tax, although most activities are subject to the business and occupation tax, unlike the sales and use tax. But both are reported on a combined excise tax return. The rate of tax is approximately 0.5% of gross sales in Washington. And the economic nexus threshold is the same, 100,000 in sales in Washington. So it's the same as the sales and use tax nexus threshold. It was higher in prior years, but they've made the threshold uniform. Hawaii also has a general excise tax. It's a gross receipts tax, and they call it a general excise tax, and applies again if you've never physically entered the state. It's approximately 4%. Hawaii does not have a sales and use tax, so this is essentially a hybrid with a higher rate, 4%. And it applies if your sales into Hawaii exceed 100,000. Oregon just instituted a corporate activity tax. This is in addition to the income tax, and applies if you've never physically entered the state. Oregon, by the way, doesn't have a sales and use tax. Sales over 750,000, you must register within 30 days or there are penalties. If you have sales of over 1 million into Oregon, then you must begin filing and making prepayments. Estimated payments are not required if you're expecting less than $10,000 of CAT liability for the 2020 tax year. This has been, the threshold's been increased from $5,000 to $10,000. The rate of tax is 0.57% of gross sales, and there's a large amount of information available on the website explaining the computation of how to compute the tax. So registering, we talked a lot about sales and use tax registration. So, and there could be a number of states in which a business may register, but they may not actually have a tax liability. And if you decide to register now, you might have had outstanding historic sales tax exposures. And the question then is, how do you handle the historic liabilities? And one of those is approaching the state with a voluntary disclosure agreement, where you would come forward and look for a limited look back period where a business may have been selling into the state for many prior years, or another instance may be acquiring a business that had been doing that but had not been sales tax compliant. This disclosure agreement would need to be pursued before registering the business. So it's good to review where your prior exposures are before moving forward to begin the process of filing returns. And oftentimes there are activity questionnaires that the states will submit asking what your activities were and when you started doing business. So it's good to consult and find out what the ramifications are of completing the registration forms with particular historic dates. Okay, so a couple of things on a checklist for entering a state. Considerations include registering with the Secretary of State. Is that something that legally your business would want to do? There's payroll reporting. There's also head tax reporting, which is Colorado, for instance, has an occupational privilege tax, which applies both to employees and employers. California has payroll taxes on particular businesses that have over a threshold amount of payroll expenses. Considerations of sales use tax license registrations, which we've discussed in this session. There's corporate franchise tax reporting, which the NEXUS thresholds are different. Only a handful of states have economic nexus thresholds. An example of when your business delivers with company-owned trucks, it may not necessarily create an income tax nexus presence, a physical presence in the state as it does for sales tax. Also verifying whether or not the states you're entering into have city taxes. In that case, the city taxes would have there might be a separate filing requirement at the local level. So Eide Bailly provides these diagnostic tests to determine whether or not you have nexus thresholds for income tax as well as for sales and use tax. And this is an example of the type of matrices we can provide to do an initial assessment of tax. So I'll end it there since our time has ended, and open it up to any questions which we can address here or after the session. In terms of, Amy, I think, should we end at this point?
Yep.
Otherwise, yep.
We did have 2 questions come through, and I think we can answer them pretty fast. What is TPP?
Oh, tangible personal property. So this is where there's a distinction that state laws make. Tangible personal property is the physical property, selling goods, selling widgets, selling components, in the barbecue case, selling food. And services are services provided through consulting services, software consulting services. So there's a distinction that's made, and often state sales tax rules will impose taxes on tangible personal property. But states have also, as a result of a lot of software intangible services that are provided these days, will roll into a definition and define perhaps downloading of software that to be, even though that can be considered intangible, they'll define it as tangible personal property that is subject to tax. So that defines the taxability of an item.
Perfect. And then the other question was in reference back to the economic nexus table. Some of our participants here were looking for it on the website but could not find it. I'm sure it's kind of hidden with all the COVID stuff, so maybe you can kind of direct them to where to go.
Yeah, is that maybe perhaps we could send a link to that website for those that are looking for it?
Yes. So Zoom will not
That
let
would be
us
perfect.
copy and paste into the chat, but we will send out that link with our follow-up, which will include the handout and the recording. So we'll include that link with our follow-up email. So look for that to come in the next couple days, okay?
Thank you very much for your time. Have a great weekend.
Awesome. Thank you all so much for attending, and thank you to our presenters, and we will talk to you next time. Thank you.